This is Fritz Meyer with the Q&A session for last Tuesday's webinar with some additional information, the first of which is the Fed's release of its most recent economic projections that came out last Wednesday, along with the Fed's most recent statement. What I've circled here is the PCE inflation central tendency forecast. And interestingly, what you see is that whereas the Fed now has penciled in 5.3 to 5.4% inflation estimates for 2021, they are expecting inflation to come down pretty dramatically in 2022 back to a range of 2.2 to 3%. So not so persistent in higher inflation. Another way of saying that is, to some degree, sticking with their transitory story, blaming the surge in inflation on supply bottlenecks related to COVID as much as anything else. Here's a picture of that, and you can see the actual PCED and the core number. Core is personal consumption expenditures deflator without food and energy. And you can see how that number has surged. But as I was saying, the dotted lines are the Fed's latest central tendency forecast for 2022 and beyond. So again, the Fed maintains that inflation, the big surge in inflation, will prove to be transitory and not so persistent, not worryingly persistent, or maybe I should say that, not at a level that is of extreme concern. I think the Fed believes, as I think most market participants believe, that if we do have inflation between 2 and 3%, well, that's something we can live with. So there you have it, the Fed's most recent view of the inflation outlook.
And what did you say exactly when you were showing that, the previous slide? So I see. So for 2022, they're predicting 2.2 to 3% inflation.
Yes.
Okay. And then
2.1 to 2.5.
Okay.
3 and so forth. Interestingly, in this picture, that they've had to bump up their 2021 estimate very substantially because the old forecasts were much too low. So the red line blew through the ceiling on the old forecasts. The September forecast, the June forecast, the March forecast were much too low, so they've had to adjust their 2021 estimate very significantly higher. Part and parcel of the most recent release by the Fed then is the so-called dot plot, in which we're looking at the Fed's latest estimate for where the Fed funds rate will be in 2022. And you can see that the majority of dots fall somewhere north of 75 basis points. And so the dot plot shows 3 expected 0.25% rate hikes in the year 2022. And I think most market participants now believe that the first one will probably come in March. Committee member Waller is on TV today, or being quoted on CNBC today, saying that probably March we get a 0.25% rate hike. So that's coming. And again, what we're looking at is the range of expected rate hikes on the part of the committee members. Each dot represents a committee member's forecast. Now we're going to move to the questions and my answers that arose from the Tuesday webinar. The first one is unemployment, inflation, stocks, bonds, blah, blah, blah. I want to hear Fritz speak on Bitcoin, Ethereum, and crypto, please. Well, the reason I don't talk about cryptocurrencies, and I really don't have much to add to the whole discussion, is that very similar to gold, cryptocurrencies are worth what you believe they're worth or going to be worth, and which is to say there's nothing to analyze in the way of earnings, dividends, or cash flows. And so I really don't have an opinion, and I won't be analyzing or talking about the cryptocurrencies for that reason. Very similar to my view of gold, and I've talked about gold in the past simply in passing, talking about the performance of gold in a portfolio. But as to having an opinion about gold, I really don't. And that's because gold, like the cryptocurrencies, is worth what somebody else will pay based on nothing other than faith. And so I just don't have much to say about the cryptocurrencies. Second question is, since I bonds are paying 7%, I'm assuming the Fed isn't dabbling with those bonds. That's correct. The Fed is not influencing the price of I bonds, and I bonds are a pretty good value as far as I can tell. Number three, to what does Fritz ascribe the dismal consumer and small business sentiment? Great question, and my answer is with respect to depressed consumer sentiment. First of all, I'm puzzled in part because I would think that that average Americans' 401ks and the nice appreciation that so many Americans have seen in their accounts would reflect in higher consumer sentiment. And here we're talking about the University of Michigan consumer sentiment. And so what I would say is probably COVID is weighing on consumer sentiment, and probably inflation is weighing on consumer sentiment. And as for the small business sentiment measure that I referred to, I think the most cited reason for less than complete optimism in this current amazing business expansion has to do with shortage of labor. In many cases, small businesses can't hire and retain the workers that they need. That's the most cited issue at present. And so we're seeing just mediocre survey results on the NFIB's Small Business Optimism Survey. Next question is, how has the explosion in M2 not put pressure on the dollar? Perhaps due to the demand in US Treasuries due to the ECB's negative rates. Yes, one would expect, and one of the theories has been that an explosion in M2 will mean an explosion in inflation and a depreciation in the US dollar. But I think what's happening is the same pressures are worldwide. So we're seeing expansion in money supplies in other economies, just as in the US, but countervailing is the point that's being made here is that there is very strong demand for US Treasuries. So our rates may be low, our 10-year Treasury bond may be at 140, but Treasury yields in Europe are negative. So that's creating additional foreign demand for US dollars with which to buy US Treasuries. I think that probably is a pretty good explanation. What percentage of the S&P 500 is made up of large cap growth stocks? I don't have the FactSet data available to me, but typically I think roughly half of the S&P 500 is considered growth and half is value. As to large cap, well, the S&P 500 is by definition large cap. So, but I don't know whether the question is really how many, what percentage is made up of those mega cap growth stocks that I talk about, the answer there is about 25% of the S&P 500 is comprised of that handful of I think it's 6 of those FANG stocks that I refer to. What sectors of stocks do better in inflationary periods? Well, classically, people talk about the economically cyclical sectors like materials and energy doing better during inflationary periods, commodities and energy. That may be, but my impression over time and my experience over time is during an inflationary period, when you're talking multi-year period of higher than average inflation, well, you'll get cyclical relative performance among all of the sectors. And so it's impossible to say that there is one or several sectors that will systematically outperform other sectors during periods of inflation. That I don't think is true. So I think that probably staying broadly diversified makes the most sense, because it will be impossible to say that, oh, this, that, or the other will outperform during inflationary periods. I think you'll have alternating relative outperformance among the sectors. Next question, and this is from Andy. How is Fed intervention via QE different from intervention by China in rigging the market? Well, both the Federal Reserve and the Chinese government intervene in money markets and the banking system in order to manipulate the economy. I'm not an expert in how China does that, but my impression is China typically uses reserve requirements in the banking system to either stimulate or restrict the rate of growth in economic activity. Again, let me say that again, the reserve requirements. And so if they want to be expansionary, they lower the reserve requirements for banks. Our system, I think, is different in that the Fed is influencing the entire term structure of yields. And so the Fed can influence interest rates on the short end and the long end of the yield curve, which is what they've been doing. I don't think the Chinese government does that. But I think that, the real answer to the question is yes, both governments, ours via the Federal Reserve and theirs by their central bank, influence the rate of economic expansion, which ultimately has an impact on markets. And so there is no difference in the fact that both governments are engaged in market influencing activities. The next question is from Andy. This question is, did the Fed chair use the word persistent to describe inflation? Here's a quotation from yesterday's paper, quoting Chairman Powell in the speech he made immediately following the release of the Fed statement, in which he said, there's a real risk now, I believe, that inflation may be more persistent and the risk of higher inflation becoming entrenched has increased. That's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk. So the answer is yes. He has now used the word persistent, and he also admonished us to not use the word transitory any longer. Is 10% expected total return a realistic projection moving forward? Does this impact velocity of money numbers? The second part of the question is I don't understand, so I'm not going to comment on the velocity of money. But is 10% expected total return a realistic projection moving forward? Well, all I can say is using 85 years of history of the S&P 500's total return, you can see here how consistent it has been. One could say, well, maybe since we are running a little bit ahead of 10% total return, as you can see in the red line, maybe there's some give back or some flattening of this for a period of time. It's certainly possible, but I would say that given the 85 years of persistence, generally speaking, 10% total return in common stocks, I would stick with stocks, even if my outlook were, well, maybe it's 8% or 6% over the next 24 months, something like that. Even if I had that view, I would say yes, but common stocks. Incidentally, the blue line in this chart is inflation adjusted. So if you think you're in an inflationary period, I think common stocks are a terrific asset to continue to hold as being as good an inflation hedge as anything I can think of. But secondly, I would stick with stocks for the long term, even if I didn't believe 10% is necessarily in the cards over the immediate future term. Is the earnings growth above trend, and it will continue to be because of Apple, Microsoft, et cetera, versus the bottom 450 stocks in the S&P 500 index? The above trend, first of all, we've seen this enormous surge in earnings from the COVID bottom, but then what you can see in this chart is that the rate of earnings growth reverts to something parallel to the 7.5% growth path. So while we've seen this one-time surge and recovery, then the rate of earnings growth going forward is expected to revert to the historic something like 7.5% here. That's point number one. Point number two is the strength of earnings growth, yes, very definitely is being influenced by those very strong growth rates that I referred to in the PEG ratio chart, coming from the likes of Apple, Microsoft, Google, Facebook, Netflix, probably NVIDIA. Those were the top market cap stocks, and those rates of growth in the 20s, 30s, and 40% are definitely having an impact on the rate of overall S&P 500 earnings growth, whereas many of the other stocks, many companies in the S&P 500, of course, aren't growing their earnings anything close to that fast. Does an increase in household wealth, like the one on slide 19, need to end in a bust? Or is there some sort of Goldilocks scenario where it would normalize over time without a catastrophe? Well, I like to think that there is a Goldilocks scenario. The experience, you can see it right in this chart, the experience from the 99-2000 peak in the stock market bubble was simply that household net worth went sideways more or less over a period of years. So there wasn't a big give back like we had with the collapse of the real estate bubble in 2007 and 8. Both the stock market and the real estate markets collapsed, and so you had a big contraction in household net worth. So you can see examples of both in this chart, is what I'm saying. And I would like to think that yes, it is very possibly a Goldilocks scenario where household net worth doesn't contract. It may simply slow its rate of increase, or it may go sideways if we had a sideways stock market and a sideways real estate market, so that we would correct to this long-term trend line. That's not a given, by the way, that you have to correct. You could simply continue higher a lot, but at a lesser positive slope for a period of time. I guess what I'm saying is there's no reason to assume a bust. You could simply have a kind of a gradual reversion to the mean in the asset classes that contribute to household net worth, financial assets and real assets. You said it takes recessions to cause stock bear market losses of 20% or more. Does that mean a recession preceded every bear market? Well, I refer back to this chart show how the chronology typically works. You can see that the stock market actually peaks and starts turning down, typically in anticipation of a recession. And so does that mean a recession preceded every bear market? I would say no, bear markets precede recession because the stock market anticipates, typically, by 6 months or something like that. But usually the stock market sniffs out the onset of economic contraction and turns down well in advance of the actuality. And you can see that pretty clearly in virtually every example here. I'm going to use my cursor, but you can see how the stock market peaked and turned down here well in advance of the onset of recession. Same thing here, same thing here, same thing here, same thing here. Please explain how logarithmic scales differ differently from a linear y-axis. Y is linear, distortion, show the math. I've tried to explain that in the sidebar in this chart. On a logarithmic scale, a constant rate of appreciation, say 10%, is represented by a constant interval on the y-axis, let's say 1/8 of an inch. That's about how this chart works out. Whereas on a linear scale, a constant rate of appreciation is represented by a steadily increasing distance on the y-axis. And that's why the charts appear to go parabolic. As the numbers get bigger, then a constant percent increase, say 10%, represents a bigger and bigger gap on the y-axis. And so that's why the distortion occurs. That's about all I can say, but I think that's clear. Please go through the expected performance of the forward earnings estimate valuations on slide 43. What are the percentage gains based on each of the three multiples? I just put numbers to this today. So today the S&P 500 is at roughly 46.45. So 48.78 would represent a 5% increase. 51.22 would represent a 10% increase. And 53.66 would represent a 15.5% increase. But keep in mind, this is not a forecast. It's not my forecast. It's simply a calculation based on earnings and PE ratio assumptions that may or may not materialize. I was just doing the arithmetic to show how the market could appreciate on the assumption that, first of all, that earnings per share do come out something like, or are headed for something like $243.91 in 2023. And then secondly, if you simply slide today's multiples forward, this is the range of values that you'd achieve under that set of assumptions.
If it gets into bubble territory.
Yeah, it does.
Then well, but I'm saying then it would go up to like 24, 25, the multiple. And what would that give you in terms of a percentage gain? That I'm just wondering.
Oh, you mean 24, 25 times earnings?
Yeah.
Oh, I know, but I don't think those. Yeah, I don't think those kinds of multiples would be realistic. And in fact, if anything, I'd be on the low end of projecting multiples going forward, because if anything, I think probably multiples are under pressure. Currently, we're at 21 times forward earnings. Well, if we get higher interest rates, both long and short, maybe 20 times forward earnings is the right number. I don't know what the right number is going to be, but if anything, PE multiple comes under pressure with higher interest rates.
That's why higher interest rates could be good for stocks.
Yeah, higher interest rates. Yeah, don't necessarily have to be negative for stocks, but I think the higher rates go, the more pressure on the market's multiple one could expect. How long does it take for the yield curve to turn negative? In the past, has it happened over months, weeks, or days? Can the yield curve collapse? So to answer that question, I thought I would just show the history of the yield curve. And that last question, can the yield curve collapse, is a good one. Here looks like a collapse, but it happened after a period of 10 years during which the yield curve was gradually flattening. And so the answer to the question is contained in the chart. Yield curves can move over a period of months and years. As the Fed is in ratcheting higher mode on short-term interest rates, well, then the yield curve gradually flattens to the point where the yield curve here in 06 and 07 went negative. But it's never a surprise. It's always obvious when it's happening. The most recent episode of that was to the extent that it went negative in 2019. And you remember all what you and I were talking about. What I was consistently pointing out is, hey, this yield curve is going negative. And I remember doing a special webinar session on that very issue. The point being that it was right in front of us. The Fed was raising short-term interest rates even as bond yields were remaining static, and so the yield curve went negative. And suddenly the Fed realized they were making a mistake and backpedaled and reversed course. So that's how the yield curve has worked. You can see how various periods, different experiences.
Thanks, Fritz. That's great answers. That's great.